Welcome to Value Vest Daily. Okay, so what if I told you that one relatively unknown small cap AI stock just exploded over 136% in a single month? Seriously. And what if I told you that unlike so many of those meme stock rallies we're always seeing out there, the underlying fundamentals, the cold hard science, and a totally pristine balance sheet actually back it up? Well, we're talking about INOD today. Innodata. So you gotta wonder, is this the next massive 10 to 100x AI winner just hiding in plain sight? Or are we just watching a classic momentum trap that's getting ready to snap right back and severely burn anyone buying in late? Stick with me, because in today's explainer, we are going full deep dive. We're gonna completely unpack the numbers, the science, the crazy momentum, the very real risks, and exactly how to evaluate this setup. Right out of the gate, we absolutely have to talk about this massive number. Plus 136%. That is Innodata's explosion in May alone. Now, before we get into the dense weeds of exactly how they pulled off this historic run, I do need to clearly state our disclaimer. This explainer is for educational purposes only and is not financial or tax advice. Okay, but looking at this 136% surge, you really have to ask yourself, how does a publicly traded company basically more than double its entire market cap in a matter of weeks? I mean, it usually requires a perfect storm, right? A massive earnings beat, explosive forward guidance, and a market narrative that just suddenly catches absolute fire. And well, in this case, INOD literally had all three of those things firing at exactly the same time. Look at this chart. This is a classic explosive gap and run. Innodata went from a pre-earnings close of right around $45 and then absolutely rocketed to an intraday high of over $104 in just a matter of days after they crushed their Q1 earnings on May 7th. Get this, at one point, the stock was up roughly 92% in a single trading session alone. No way, right? That is just incredible energy. Now, it eventually pulled back slightly, settling into that $90 to $100 range, which established a really powerful new base. But you have to understand, this wasn't some slow, creeping realization by the market over several quarters. This was a sudden, violent repricing of the company's entire future value. And to truly comprehend why the market reacted this aggressively, we have to unpack the underlying technology they're working with. All right, let's jump right into Section 1, AI Picks and Shovels. You know the old saying, right? If you want to find the real winners in a gold rush, you don't necessarily buy the companies panning for the gold, you buy the companies selling the highly specialized picks and shovels. Well, Innodata is essentially a behind-the-scenes AI data engineering powerhouse. They aren't out there trying to compete with the massive tech giants to build the foundational models themselves. Instead, they're providing the absolute critical, deeply technical tools required to make those giant models actually function. Think about it like this. On one side, you have big tech, the Magnificent Seven, spending tens of billions of dollars on pure compute power to build generative AI models. But on the exact opposite side of that equation, you have INOD preparing the actual training data. Let's take our time here and really deep dive into the science. Generative AI models, like large language models, are essentially just massive statistical engines. They learn strictly by recognizing complex patterns in data. But if you feed an AI model raw, unorganized, messy internet data, guess what happens? It produces messy, inaccurate, and completely fabricated outputs. The computer science industry officially calls these hallucinations. So, to solve this massive roadblock, big tech desperately needs incredibly clean, highly structured, and infinitely scalable training data. It's the single biggest bottleneck in modern AI right now, and that is exactly what Innodata solves. They employ specialized engineers to annotate, label, and painstakingly prepare these massive data sets. We are talking about highly complex tasks here, like reinforcement learning from human feedback, or RLHF. This is where human experts actually sit down and rank AI responses to teach the model nuance, logic, and safety. It involves drawing millions of precise bounding boxes for computer vision models and executing really nuanced natural language tagging. It's essentially human-in-the-loop verification done at an industrial scale. For years, Innodata was just a steady, kind of sleepy services business. But then, boom, the generative AI revolution hit, and the scientific demand for pure, human-labeled datasets went absolutely parabolic. They are literally one of the very few public pure plays on the required data science of AI. Moving right along to Section 2, the Q1 earnings blowout. When you have a totally essential, highly scientific product in a booming sector full of cash, eventually that's going to show up in the financials. And boy, did it ever show up here. Let's really look at this data dump, because these cold, hard numbers are what fundamentally triggered that wild 136% rally. Q1 was just an absolute blowout across every conceivable metric. Look at the top line. Revenue hit an all-time record of $90.1 million. That's a massive 54% growth rate year over year, and it completely shattered Wall Street's consensus estimates of $76.5 million. They beat it by a totally stunning $13.6 million margin. But honestly, the bottom line is even more impressive. Adjusted EBITDA just exploded to $25 million. That is up 96%, basically doubling last year's output, and it came in a staggering 139% above what professional analysts expected. Net income more than doubled to $14.9 million. So why the massive sudden beats? It comes entirely down to scale and pricing power. Because AI data training volumes are surging so rapidly right now, Innodata is processing exponentially more data than ever before, and their proprietary workflow automation tech lets them do it with incredible efficiency. Now, the absolute crucial data point is right here, 47%. That's their adjusted gross margin, and it expanded significantly in a very short amount of time. Now, in a specialized services and data engineering business, hitting a 47% gross margin means you are finally achieving incredible operating leverage. See, for years, Innodata had to invest heavily in their baseline infrastructure, their proprietary tech stack, their global workforce. Those were massive fixed costs. But now that this immense volume is pouring in from big tech, those fixed costs are already totally covered. What does that mean for us? It means that a massive percentage of every brand new dollar of revenue is dropping straight to the bottom line as pure profit. That is the textbook definition of operating leverage. And let me tell you, it's exactly what sophisticated institutional investors are hunting for when they look for a multi-bagger stock. But the management team didn't just pat themselves on the back for a great quarter, they pointed heavily to the future. These are the growth catalysts that really caught Wall Street's attention. First up, they aggressively raised their full-year revenue organic growth guidance to roughly 40% or more. That is a significant jump from their previous 35% estimate, which, by the way, they had just issued 10 weeks prior. Financial visibility for this company has literally never been better. And then, they dropped a massive market-moving bomb. They legally secured a new engagement with a major big tech customer that is confidently expected to generate approximately $51 million in revenue. Think deeply about what that implies for a second. This isn't some fluffy maybe or a we hope to win this sales projection. No, this is contractual, pipeline-ready growth that's already locked onto the balance sheet. The deep science of their RLHF and data prep is so critically vital right now that big tech is literally locking them down with multi-year contracts just to guarantee they have access to their workflow. Let's shift gears to Section 3, riding the momentum. Because look, while scientific fundamentals build the long-term base, momentum is what actually drives the stock from $45 to $104 in just a few days. After that earnings report dropped, the social buzz just went completely parabolic. Retail sentiment flipped to extremely bullish almost overnight. Message volume jumped a ridiculous 7 times in just 24 hours. What we saw here were textbook post-earnings gap and run dynamics fueled by massive, undeniable trading volume. When a small-cap stock crushes earnings to this extreme degree, you almost invariably get short squeeze vibes. The funds and retail traders who were betting against the company rush in total panic to cover their short positions. And that perfectly collides with a massive flood of new retail investors piling in to catch the ride. It creates this powerful, self-feeding loop that acts literally like rocket fuel on the share price. And it definitely wasn't just retail jumping on the bandwagon here. The smart money and professional equity analysts jumped on board too. We saw immediate Wall Street upgrades. Wedbush, for example, significantly raised their price target. So now the institutional consensus sits comfortably around $95, with high-end bull targets stretching all the way to $111. From a technical standpoint, the stock just sliced right through thick multi-month resistance levels on massive volume. Now, we do have to note that the RSI, the Relative Strength Index, is definitely elevated. In plain English, an elevated RSI simply means the stock is currently trading significantly hotter and faster than its historical averages. So it's technically overbought in the immediate short term. And as we always say, the trend is absolutely your friend until it isn't. But remember, this specific price action is classic momentum fueled by actual tangible scientific fundamentals and contractual revenue. This isn't just pure meme energy and internet jokes. All right, Section 4, valuation and real risks. Okay, let's take a breath, purposely slow our pacing down a bit, and switch entirely over to cold logic. Because as value-conscious investors, we have to completely strip away the internet hype and that flashy 136% return, and rigorously look at what we are actually paying for the business today based on the math. Here's the fundamental financial base at current levels. The company trades at a forward price-to-sales multiple of roughly 10 to 12x. Now, is that objectively cheap? No, absolutely not. But you have to contextualize it within a discounted cash flow, or DCF model. When we evaluate if an individual stock is a buy, the DCF model is absolute king. We are looking at a company with contractual, expected organic growth of 40% or more. Plus, look incredibly closely at this balance sheet. $117 million in pure cash and strictly zero debt. In a DCF analysis, having absolutely zero debt is massive because it significantly lowers the company's weighted average cost of capital, or WACC. A lower WACC basically means the discount rate we apply to their future earnings is smaller, which makes those future earnings inherently way more valuable to us today. And when you mathematically model out 40% top-line growth, cascading down through those expanding 47% gross margins we talked about earlier, the future free cash flows look incredibly robust. So while a 10 to 12x forward PS seems a bit rich on the immediate surface, for a high-quality, deeply integrated AI enabler with a fortress balance sheet, it's actually not insane at all. So let's logically weigh the scales as experts here. The bull case is exactly this. If Innodata continues to execute perfectly on their scientific data annotation and hits, say, $400 to $500 million in revenue in the next 2 to 3 years while maintaining those 30% or higher EBITDA margins, the underlying math starts screaming true multi-bagger potential. That is your realistic 10x case from their historical baseline. But as objective, data-driven analysts, we must heavily acknowledge the bear case too. First off, small cap volatility is intensely real. These specific stocks will swing wildly on macro news. Second, if there's an overarching AI capital expenditure slowdown across big tech, well, Inode's future pipeline is going to dry up incredibly fast. And third, you have the ever-present looming threat of deep pocketed competition. I mean, what if substantially bigger tech players enter the specialized data space, or big tech just decides to take all this complex RLHF engineering entirely in-house? Look, after a 136% run-up, market expectations are officially sky-high, and any operational miss is going to hurt the share price significantly. And finally, Section 5, the final verdict. We have meticulously looked at the underlying AI science, the blowout financials, the wild market momentum, and the strict DCF valuation logic. So, is this an actual 10 to 100x opportunity or just a devastating momentum trap? Well, my verdict as your host, real, deeply entrenched AI tailwinds, combined with actual, proven operational execution equals a legitimate multi-bagger setup. This isn't a trap right now. It's a high-conviction growth story backed by real, contractual revenue. Now, do I think it's 100x from today's already elevated levels? Probably not. But a 3 to 5x return over the next 3 years is highly plausible, if overall corporate AI spending keeps roaring. That being said, you must carefully size your position and ruthlessly manage your risk because this stock moves incredibly fast. If you're looking to start a position, I'd be a buyer on any meaningful, broader market pullback into the $70 to $75 range, heavily utilizing a tight stop loss to adamantly protect your capital. Now, I really want to hear your analytical thoughts on this setup. Are you buying it odd, watching it carefully from the sidelines, or staying far away from this kind of extreme volatility? Please subscribe, like, and share ValueVest Daily for daily learning opportunities before you put your money to work. Please put in a comment if you want us to deep dive into any specific high-risk/reward opportunities. Thanks for joining me on this explainer. Trade smart, and I'll see you in the next one.